This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 3 videos on trading climactic reversals. A climactic reversal is a failed breakout. I'm going to be talking about minor climactic reversals today. This is a 5-minute chart of the euro versus the dollar. Remember the market cycle. Every strong trend usually transitions into a trading range and not into an opposite strong trend. When you get a reversal in a bull trend, it usually is minor and becomes either a bull flag or a trading range. Once it's in a trading range, then it might become an opposite trend. You might get a major trend reversal. Here, the bears are making an attempt at a lower high major trend reversal. We have a buy climax here and bad follow through. The market was rallying weakly and then it became strongly bullish. We have a big bar and it's a climax bar. Every trend bar is a climax, and when you have a breakout like this with a bigger bar, it's a climax. And a climax usually leads to exhausted traders. Here you have bulls, so exhausted bulls. Bear scalpers might sell the close of the follow-through bar. If the follow-through bar was a big bull bar, they would wait. For example, here's a buy climax, but the next bar is a big bull bar, so traders are not going to sell. The next bar again is a big bull bar, so they're not going to sell. And now we're starting to get some profit taking, some lack of buying, and bear scalpers might sell. When a channel is tight like this, a 7 or 8 bar bull micro channel, most traders are not going to sell that doji bar, even though it's weak follow through. Here you have a chance of a final flag, but the pullbacks are so small, it's still a small pullback bull trend, so that is not a very good looking sell. If a trader did sell that bar, betting that this is an exhaustive buy climax and the end of the trend, he would buy back his shorts when a high 2 triggers. High 1, high 2, especially above a bull bar. And the same is true here. The high 1 is above the doji, and here's a high 2 above a bull bar. Traders would buy back their shorts. If they shorted looking for a scalp down, it did not fall 10 pips, the minimum needed for a scalp. You can call it a high 2, 2 legs down, 1, pullback 2, and it's a small wedge bull flag, 1, 2, 3. And you'd either buy above the doji or above the bull bar. Again, I would not take these shorts. But if a trader was looking to sell an exhaustive buy climax, that would be the short he would take. A big bull bar and then a pause bar, the end of the climax. A big bull bar and then a pause bar, the end of the buy climax. Had they taken the short, again, he'd buy back a short here, a high 2 or a wedge bull flag, and he would buy back the short here, another high 2. The bears will sometimes allow the bull trend to resume one time, but they usually do not allow it to resume a second time. And that's one of the reasons why high 2 bull flags are good buys, because the bears will give up when the bull trend resumes a second time. The bull trend resumed the first time, some bears would hold short. But if it starts to resume a second time, they'll buy. If you're selling a buy climax, the goal is a scalp, because most likely what will happen is the bulls are exhausted and they'll stop buying for 10 bars and 2 legs, approximately, sometimes more. And you're hoping that you'll get a deep enough pullback for a scalp. Again, even though this is a wedge, 1, 2, 3, a parabolic wedge, the pullbacks are all very small, and therefore taking any of these shorts is a low probability bet, and I would not take them. Again, a 5-minute chart of the euro versus the dollar. We have a very big bear breakout. Every bear breakout is a sell climax. We have a pause bar here, and now we have a second leg down. This is strong enough so that a second leg down is likely. We have a pullback, a 1 bar inside doji bar, and then we have a second leg down here. Usually after the second leg down, you get some kind of pause, and the target after a sell climax is a test of the top of the most recent sell climax. This most recent sell climax is 1 bar. So if a trader bought here or above here, their minimum target is a test of the top of that sell climax bar. Again, is this likely to reverse from a bear trend into a bull trend? No, it's most likely a minor reversal, and bears buying either the close of that bar, the close of this bar, or above the high of this bar are simply looking for a scalp. And you only take it if the target is at least 10 pips above your entry price, because there probably will be sellers at that high. You'll have bull scalpers selling out of longs there, and you'll have bears selling, betting that the bear trend will resume. Again, a climactic reversal usually results in a trading range, especially if it's coming after a very strong bear trend. It usually does not result in an opposite trend. After it's been in a trading range, then traders might start to look for a major trend reversal. Again, you could buy the close of that bear bar, you could buy the close of the bull bar, or you could buy above the high of that bull bar with a stop, betting that you'll get a minor reversal and a scalp. Take profits at the top of the most recent sell climax. Again, this is not a particularly good trade. You can take it if you're an experienced trader, especially if you can use wide stops and scale in. But most traders, when they see a trend that looks like this, have a better chance of making money looking to sell a rally, like a two-legged rally, 1 pullback 2, testing the top of the sell climax. 2 legs up, 1 pullback 2, a double top with the top of the sell climax bar. Odds are we'll resume down at least a little bit. We might be transitioning into a trading range. Here we went sideways for about 15 bars, 20 bars. However, it's still a reasonable short. The market's still always in short, and chances are the bears will get at least a little bit of trend resumption. If a trader's buying a sell climax, he knows it's a minor reversal when the channel is tight like this. His goal is to get a scalp, betting that the market will trade up high enough for him to scalp out. Here you have a small double bottom, a neckline, did not rally quite to a measured move up. I didn't check. Maybe we have a double bottom, neckline, maybe it broke above, around a measured move up. Is this a swing up or a leg up? No, it's more of a small leg up. It's more of a bear flag. The bulls tried to get a double bottom, higher low, major trend reversal, but 5 bars in a tight channel like this is probably not going to lead to a reversal. And now they're trying to get a lower low, major trend reversal, but again, very, very tight bear channel. It's a low probability bet buying above that bull bar. Higher probability buying above maybe the double bottom here, this low and that low bull bar here. Five-minute chart, euro versus the dollar. Again, a buy climax, and a very big buy climax with a second leg up. When you have a fairly tight bull channel like this and you have a buy climax, especially when you have a second one, first one and then a smaller second one, usually the best the bears will get is a trading range, a test of the bottom of the most recent buy climax, maybe the low of this bull bar or the low of that bull bar. If they then get a trading range, they can then hope for a major trend reversal, which they got here. Consecutive buy climaxes here, 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 usually transitions into a trading range, 10 or 20 bars. And once it's in the range, then traders can start to look for a major reversal. Every trend bar is a climax. Every series of trend bars is a climax. Every trend bar is a breakout. Every series of trend bars is a breakout. Here we have a bull breakout, and we have a pullback. And there's a gap between the bottom of the pullback and the top of the breakout point, and it might lead to a measured move up. This low to that high, measured move up, or this low to the middle of this gap and possibly a measured move up. For the bears, they see a wedge channel, 2 highs, and then we're breaking above the top of the channel, and the market also is up near a measured move. Of all the buy climaxes that I showed today, This is the first one where the bears have a reasonably good chance at making money. It's at a measured move target, and we have consecutive buy climaxes. We have 1, 2, and then pull back, and then break out in 2. This is likely to have a second leg up. You have the second leg up, and it's at a measured move, and we have a failed breakout above a bull channel, and it's a second reversal attempt above a prior high. So a trading range, breakout, first reversal attempt, second reversal attempt. This has a reasonable chance of at least a couple legs sideways to down, maybe testing the bottom of the buy climax. Of all the fades that I showed, all the selling of buy climaxes or buying of sell climaxes, this is the first one that I think would be reasonable. This is the first one that I would consider taking. It's also a variation of a low 4 top. What we have is an attempt at a top here, leg 1, leg 2. The top failed, and then we got leg 1, leg 2. So it's a complex top. The market tried to top out here around this high, and we got a breakout and then a second leg up. So we have 2 complex tops, 1, 2, so a complex top here, and then a breakout and then a second top. A complex top means a low 1 and a low 2, and then low 1, low 2. A complex top means you have 2 or 3 legs up in the top, and that also increases the probability that we'll get at least a trading range and a test of the bottom of the final buy climax. It's reasonable to take a short here with the stop as well. You have a good sell signal bar. Either sell below the II, the bull inside bar, or below the bear bar. Not much room for a scalp. If you're looking for a test of this low, you cannot be selling here because you need at least 10 pips room to your target, and there probably will be buyers at the bottom of this low. What happens here, you can see we're pausing. We're getting profit taking at the bottom of the most recent bull breakout, and that's really common. When you have a buy climax and a reversal, the first target is the bottom of the buy climax, either here or here, and you'll get profit takers there. The bears who sold here had enough room for a 10 pip scalp. The bears who sold here did not, and they probably would buy back on the reversal up. We have a buy climax, consecutive buy climaxes, and the market typically transitions from a bull trend into a trading range. Once it's in a trading range, the market may resume up. The bulls have a double bottom bull flag, or it might reverse down. The bears have a double top, lower high, major trend reversal, and it's reasonable to short. Most major trend reversals have about a 40% chance of a swing down, and this is an example of a major trend reversal that, in fact, did have a swing down. When you have a tight trading range and a double top and a tight trading range after a climax, the probability of a swing down is probably higher than 40%. I don't know that it's 50%, but it's certainly higher than 40%. We have a bear breakout here. If you're taking the short, let's say you take a second entry short below this bull bar or below this bear bar, for example, the risk is small. You're risking about 10 pips looking for a swing down, and the market, in fact, fell about 50 pips. You're looking for a trade that has small risk. You sell here, stop above the double top, big reward, so very good risk-reward ratio. Usually that means the probability is low. Most major trend reversals have a probability of about 40%. This might have slightly higher because of that double top, but in general, a major trend reversal has about a 40% chance of a swing down. And that makes sense. Whenever you have a very good risk-reward ratio, you have to assume the probability is not so good, so the probability is about 40%. If you want a higher probability trade, you wait for the breakout. After a pair of bear bars or 3 bear bars closing near their lows, you can start to sell closes. We have a pullback from the bear breakout. You could sell below the low of that bear bar. Here we have a double top. Sell below the low of that doji or below that bear bar. Would you get out above this bull bar? Some traders might, but if they do, they'll look to sell again below the low of this bar because this is not enough to flip the market from always in short to always in long. Wedge, probably a minor reversal. The channel down is tight, the reversal bar is small. We're always in short. If you did get out above this bull bar, you got to sell again on the reversal down. Is this a major lower high? No. Is this a major lower high? Probably not. This is the most recent major lower high. This is only 1 bar down. This is only 2 bars down, not particularly big. And therefore, a lot of traders will not exit above the top of this tight trading range. They'll keep their stop above the top of the sell climax because this is the most recent major lower high. Swing traders, therefore, would not necessarily get out above here or even above the tight range. If a trader did get out, they got to sell again. The market's still always in short. The bull reversal is failing. They can sell below that bar or they can start to sell closes. When you get a big bar like that, especially a gap, the open of this bar is below the close of that bar. It tells you that traders are selling the market. As soon as this bar closed, they hit the button to sell the market. And you can see they get filled below the close of that bar. So many traders were so eager to sell that if they sold that close, they get filled on the open of this bar, and the open of this bar is below that close. That means there's a lot of urgency, a lot of traders wanting to sell. And that means the market's probably going to have at least a small second leg down. 5-minute chart, euro versus the dollar. We have a bear breakout. The bulls are trying to create a bottom, and instead we're getting a bear breakout and good follow-through. This is the open of the European session, but look at the follow-through after the initial breakout. Bulls tried to reverse, bulls tried to reverse again. That makes you wonder, is this going to be a measuring gap leading to a trend down or an exhaustion gap? Whenever a session is opening, traders are always watching for a breakout up or down, and they know that whatever breakout they see, there's a 50% chance it's the wrong direction. At the start of a session, if you see a breakout here down, 50% chance it's the start of a trend down, 50% chance it's a test down, and buyers will come in and the market will reverse up. Here we have a second entry buy. We have a micro double bottom, a good looking bull bar closing on its high. It's a reasonable buy looking for a swing up, betting that this is an exhaustion gap rather than a measuring gap. The gap at this point is the high of this bar and that low or any of these lows, and ultimately the gap closed. A bear trend, a tight trading range. Whenever you have a tight trading range late in a trend, it often is the final bear flag. It's a magnet, and if the market breaks below it, the market tends to get drawn back into it. And here, not only did it get drawn into it, it started to reverse up and broke above it. Micro double bottom and a very strong buy signal bar, and you're at the start of a session. A reasonable buy betting that this breakout is a bear trap and that it's going to reverse and create the low of the next 2 or 3 hours. 5-minute chart, euro versus the dollar. A bull breakout, you can call it a buy climax, a bull trend, and then we have a bear reversal. You can call it a sell climax or a bear breakout. And the market's rallying. It looks like a lower high, a bear flag, and it starts to break to the downside, but it goes more sideways. And now we're getting a bull breakout above a bear flag. It's a failed wedge bear flag. For the bears, they're going to look at this and say, I know what's going on. We get a breakout, a second leg up in a trading range. It could be a second leg trap, and it could lead to a reversal down. It's a bull breakout. It's therefore a buy climax. And we're getting a pretty good reversal down. At this point, we have big up, big down, big confusion. You assume sideways, and then either trend resumption up or trend reversal down. Some traders, the bears, will sell this reversal up attempt, betting that this is a bear trap, that this rally is a second leg trap in either a broad bear channel or in a trading range, and it's failing, and they'll bet on a second leg down, maybe a swing down, and therefore they'll look to sell. One way to sell is sell above the high of the prior bar, and you get filled right there. Their risk is not big. They'll get out above here, and they're hoping for a swing down. Bulls might buy this as a pullback from this bull breakout, and their risk is not big either. They'll probably put their stop below these bars, hoping that the market continues up. For the bulls, the buy climax was followed by a reversal, a climactic reversal, and a test of the bottom of the buy climax. The bulls are trying to create a double bottom. They want the market to break above the neckline of the double bottom and rally for at least a measured move. Again, the bears are hoping that this is a second leg trap in what is either a bear channel or a trading range. So first leg up is a wedge, and now we have a stronger second leg up, a breakout. The bears are hoping this is trapping bulls into believing the breakout will be successful, when in fact it might be an exhaustive buy climax and end of the rally. Bulls looking for a measured move up, either based upon this double bottom neckline measured move up, or based upon the height of the entire leg up. Bulls who did not buy would buy here. We have two legs down, one pullback two, testing the bottom of the buy climax, therefore forming a double bottom, and they have a decent bull bar here, so they could buy above that bull bar or above this inside bar, taking a chance that this is the start of a swing up. At this point, you don't know. It's a tight trading range. I think it's slightly more bullish than bearish. We have a bull breakout and the reversal down held above the bottom of the bull leg right here, and we got two legs down. I think we're always in long, and it's slightly more bullish than bearish. However, the reversal down is strong, and now we're fairly neutral, a tight trading range. The bears could still get a double top and break below the neckline, and then a swing down. And this is what happened. Traders who took the buy here had a strong bull breakout and good follow through. Traders who wanted a higher probability buy and did not want to buy in the tight trading range after the bear reversal would wait to buy closes either here or here. This is bears giving up. They hoped that this was a climactic reversal and that this was a buy climax and the end of the bull trend. And instead, the bear reversal attempt failed and it became a bull flag, a pullback from this breakout. And now the bull trend is resuming. The bears are giving up. They have a high two. The market's probably always in long from this breakout. And the bears will buy back their shorts above this bull bar. And you can see they bought aggressively. And the bulls became more confident of a swing up as well. And that's why we have two consecutive big bull bars. Buying here compared to here, higher probability of making money, but your stop is further away. If you buy here, your stop is below the double bottom. If you buy here, your stop is still down there, so your stop is 3 times as great, but your probability is higher. Both are reasonable buys. Small wedge. We have a buy climax, probably at least one more leg up. Here's that one more leg up. And we have another bull breakout, bad follow through, another bull breakout, small bar, bad follow through. It looks like we're starting to get some profit taking. It's reasonable to exit below that bar or below this bear bar and wait to see what happens. Consecutive buy climaxes, 1, 2, 3, 4, 5. And the bull breakouts are getting smaller. This one is weaker than that. This one is only 1 bar, weaker than this. And this one is smaller again. So the bulls are losing momentum, and the bull trend is probably transitioning into a trading range. Can the bears sell this? They have consecutive buy climaxes, and now they have a small double top. You can call it a triangle. We went up here, and then again here. So this whole thing is a triangle. It's not really enough bars for a major reversal. It's only 3 bars down, 4 bars up. This is probably a minor reversal. The bears who are selling this are looking for a scalp because the best they probably get is a test down to the bottom of the most recent buy climax, maybe down here. Not a very good sell, but an okay scalp. 5-minute chart, euro versus the dollar. Very strong bull breakout, but look at the screen. We're up, we're down, we're up, we're down, we're up. We're in a trading range, we're down again. Trading ranges often have very strong second legs. First leg up, pull back, second leg. First leg up, pull back, second leg. And that second leg is a breakout. It's an attempt to convert the trading range into a trend. It did create a brief trend on the breakout above this part of the range, but it's also still in a larger range, and this could be simply a buy vacuum test of resistance at the prior lower high. Strong second legs when the market is still in a range usually are traps. That means the strong breakout is usually an exhaustive end of the rally and not the start of a bull trend. Trading ranges resist change, and therefore most breakout attempts fail. We have a strong breakout attempt by the bears, failed. We're getting a strong breakout attempt by the bulls, failed to get above all the bars to the left. We got above this high, but if you look further to the left, we're still below the top of a trading range. Whenever you see a strong second leg up and you look to the left and you say, wait a minute, that's a strong second leg up, but we're not above all the bars to the left. We're still in a trading range. Whenever you see a strong second leg up and the market might be still in a trading range, you should assume it's a second leg trap and that it will probably fail. Some traders will just sell with a stop below that bar. Others would wait for a second entry short and sell below this bar. First entry is here, and then we have a pullback from the bear reversal and a second entry short here. Or they could wait until we get 2 or 3 bear bars and then start to sell closes. It doesn't matter where you shorted, your stop is going to be above the top of the climactic reversal. This is a strong breakout, and therefore the odds are the bulls will get at least a small second leg up. That means the bears will need at least a micro double top. So at the close of this doji bar, odds are there are buyers below, and there are probably buyers all the way down below the bottom of the trading range. However, the bulls tried to resume up on this bar, and all they got to is around the close of this bar. You have by the close bulls disappointed by this bar and by that bear bar, and when you see this tail up at the close of that bar, that tells you that a lot of the bulls were disappointed by these 3 bars, and they decided to sell out of their longs, and that's what created that tail. And now we have a second entry short. The bulls who bought that close or that low are giving up. Minimum target, the bottom of the most recent buy climax, this low, or the bottom of the bull leg here, or even the bottom of the trading range. Bottom of the buy climax, reasonable to take profits here, especially since we're reversing up once, we're reversing up a second time, and here a third time. And we're still above the bottom of the trading range. And therefore, you have to assume we're probably not going to go a lot lower. Bear breakout, expect a second leg down. You have your second leg down. Remember my 80% rule. In a trend, 80% of the time the market tries to reverse, it'll fail, and the trend will continue. If the market's in a trading range, 80% of the breakout attempts will fail, and the trading range will continue. Trying to get a bull breakout, a bear breakout, bull breakout, bear breakout, bull breakout. Because of that, when you see a very strong bull bar like this, and then you see a reversal bar like that, chances are buyers below, but look at the location. You're at the top of a trading range, and it could be a second leg trap in a trading range. Therefore, it's usually better not to buy with a limit order at the low of that bar. Do you want to buy with a stop above this bar, a high one buy? I would not. We have a doji here, a bear doji here, a bear bar here. I would wait for a second entry buy, and it never came. Trading range, you don't want to be buying high. You want to be buying low. 5-minute chart, euro versus the dollar. Broad bear channel. So it's a weak bear trend. A bear channel in general usually has a bull breakout and usually evolves into a trading range. A bull channel is a bear flag, and 75% chance you'll get a break below the bull channel and then an evolution into a trading range. Here we have a broad bear channel and we're getting a breakout. So it's therefore a climax. However, there's not much emotion. We're not getting consecutive big bear trend bars, and we're really not falling all that far in terms of the number of pips. Therefore, this is a breakout, but the bears are not exhausted. It's not like the market's been falling sharply. It's been falling in a weak way with a lot of small bars and bad follow through after bear bars, and then a 15-bar tight trading range. We got a breakout, not especially a big bar, and we have a follow through bar, but not especially big either. The bears are not exhausted. They were not working all that hard on this sell-off. Bears are exhausted if the market's falling very quickly with a lot of big bars. Traders just get tired and they start to take profits. They are not exhausted with this, and therefore this is not very climactic. Sell climax. Second leg down has two small legs down. It looks like this is a bear leg and what will become a trading range. Traders will buy and buy more lower. We have a reversal up and a pullback from the reversal up. You expect a second leg up. They'll buy on a stop here, looking for at least a small second leg up. You only take the buy if you're willing to go for a minimum scalp or a greater. In other words, if you take the buy, you have to be planning on making at least 10 pips profit. Otherwise, do not take the trade. This is late in the Asian session and the bars are getting really small, so the market might become very quiet. We're in a broad bear channel. The market rallies to about half the height of the most recent bear leg and sells again. A sell-off rallies around the middle third, sells off again. We're breaking out to the downside, rallying somewhere in the middle third of the most recent bear leg. It's an area where bulls will take profits, especially since the reversal up is not strong, and bears will look to sell. You can call this a low 2 bear flag, low 1, low 2, or a wedge bear flag. 1 push up, 2 pushes up, and then 3 pushes up, and then you have a bear bar. A lot of small bars, not much movement, probably going sideways, so not a great short, and many of the traders who took this short would be disappointed by these small bars and they would just get out with a small profit. Swing traders who took this buy still expect a trading range. This is a bear leg in a trading range, and the way this rally is going up without big bull trend bars, without consecutive big bull trend bars, it's probably a bull leg in a trading range. If a trader did not exit here, he would look to exit around the top of the most recent sell climax, which is right here. And you can see sellers came in there. You can either sell with a limit order at the high of the most recent sell climax, or you can sell out of your longs on the reversal down. Sell climax after a pretty weak bear trend, you have to assume it'll lead into a trading range and not a bull trend. The bears are not exhausted. There is not a series of consecutive big bear bars. There's not much energy in the market. That means both the bulls and bears think that the price is just about right. Probably not going to go down very far, and probably not going to reverse up very far either. 5-minute chart of the euro versus the dollar. We have a big sell climax, a bear breakout. Every breakout is a climax. We have a micro double bottom with a good looking bull bar closing on its high. You could also call it a big high 2 buy, high 1, and then trading range high 2. And then if you look at more bars to the left, this is what you have. The pink line right there. And here, this sell-off is 2 legs down, leg 1, pullback leg 2. So this is a high 2 buy. And it's also a breakout test of this small trading range here. Therefore, the context is good for this to be a sell vacuum test of support and the end of the selling instead of the start of a strong leg down. Whenever you have a bear trend that might be ending, the minimum goal for the bulls is 10 bars, 2 legs, sideways, 2 up. Less likely the tight bear channel will become a bull trend, but at a minimum, traders are looking for a couple legs up, maybe lasting 10 bars, and testing the top of the most recent sell climax. And the bulls got a pretty good rally, about a 40 or 50 pip rally. If a person took that buy, they can hold for a swing. They certainly can hold for a scalp, a test of the top of the most recent sell climax. Here's a higher low, not many bars, only a few bars up, a few bars down, probably a minor reversal, and the best the bulls probably will get will be a trading range. However, the leg up still went up about 40 pips, 30 or 40 pips, even though a minor reversal. We have 4 or 5 bull bars, several closing on their highs. The market's probably going at least a little bit higher. The bears are giving up in here, so you can buy for any reason. For example, buying the close. Probably will go up for some kind of a measured move. We have a double top attempt here, and we're breaking above the top. Maybe we'll go up for a measured move. Double top, and then the neckline of the double top, instead of coming down breaking below the neckline, we're breaking above the double top, might go up for a measured move. The bulls who bought for a swing, this is a good location to take profits. It's also near the top of the leg down. You can either take profits with a limit order or on a reversal down below the bear bar. Can the bears sell this? It's the top of a channel. You can call it a wedge. I think it's not a great limit order sell, but the location is good. You're at a measured move, top of a channel. I talked today about minor climactic reversals, smaller climaxes in markets where there's not much momentum. The market usually converts into a trading range instead of an opposite trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 3 videos on trading climactic reversals.